Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance with a healthy dose of skepticism and a passion for uncovering the truth. I'm your host, Louis, and I'm excited to share today's top stories with you. We're starting off with a bit of a mixed bag, folks. On one hand, we have Tesco, the UK-based retailer, which seems to be doing reasonably well despite the challenging economic environment. According to a report by Forbes, Tesco's market share is growing, and their food volume growth, combined with excellent cost controls, gives reason to believe that margins can remain steady this year. The company's CEO, Ken Murphy, appears to be optimistic about the consumer remaining healthy, backed by positive real wage growth. However, on the other hand, we have some concerning news from the U.S. retail sector. A report by Seeking Alpha reveals that retail sales sank 0.9% in May, which is worse than expected. This marks the second straight monthly decline and the largest in over 2 years. Core sales, excluding autos, also fell 0.3% in May, down from April's 0% reading, and lower than the expected 0.2% growth. Now, let's take a step back and look at the bigger picture. The UK's macroeconomic outlook doesn't look particularly promising, with April's GDP showing a larger than forecasted contraction and the unemployment rate at its highest level in almost 4 years. Meanwhile, in the US, consumer spending is pulling back, which could have significant implications for retailers like Tesco. As we navigate these complex economic waters, it's essential to remain cautious and not get too caught up in any one particular narrative. We need to consider multiple perspectives and weigh the evidence carefully. So, what does this mean for investors? Well, Tesco's valuation looks appealing, with a forward PE of 14.6, lower than the sector average. However, we must also consider the potential risks and uncertainties surrounding the UK economy. We'll continue to monitor these developments and provide you with in-depth analysis and insights on the Riskwiser Zone. For now, it's essential to remain vigilant and adapt to changing market conditions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the world of finance and risk management. In this segment, we'll be discussing the current state of the market and what experts are saying about its future direction. We've been seeing a lot of volatility in the market lately, with various factors at play, including geopolitical tensions and liquidity concerns. According to Louis Riskwiser, founder of AIDailyPress, the market has reached a corrective phase after a significant rally from its April lows. He believes that the Nifty may be headed for a further correction, potentially reaching 24,200 before bouncing back. On the other hand, Dinakar Panala's guest, Dinakar is not available, but another expert had a different take on the market. They suggested that the recent RBI measures to boost liquidity could help mitigate some of the downward pressure on the market. Additionally, they pointed out that certain sectors, such as pharmaceuticals and FMCG, may be more resilient in the face of market volatility due to their defensive nature. It's also worth noting that another expert had mentioned that NBFCs are likely to benefit from the current liquidity situation, while others, like Louis Riskwiser, believe that its stocks could see a correction. Ultimately, as with any market forecast, there are varying opinions and perspectives. As we navigate these complex market dynamics, it's essential to remain informed and adapt to changing circumstances. We'll continue to bring you the latest insights and analysis to help you make sense of the risks and opportunities in the market. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're closing out today's show with a look at some major developments in the world of finance and politics. Yesterday, the Senate voted 68-30 to approve the Guiding and Establishing National Innovation for U.S. Stablecoins or GENIUS Act, which aims to establish a regulatory framework for stablecoins. This landmark legislation has been hailed as a major win for the crypto industry, but not everyone is celebrating. Some critics have raised concerns about potential conflicts of interest, particularly with regards to President Donald Trump's family businesses and their involvement in the crypto space. The bill does include a provision that would prevent members of Congress and their families from profiting off of stablecoins, but it does not address similar concerns related to the president and his family. Meanwhile, Senate Majority Leader John Thune is facing an uphill battle in his efforts to push through a sweeping megabill, which includes a range of provisions related to taxation, healthcare, and other issues. With various factions within the GOP expressing concerns and reservations, it's unclear whether Thune will be able to meet his ambitious timeline for passing the bill. On a related note, a new report from the Congressional Budget Office has shed some light on the potential costs and implications of the megabill. According to the CBO, the bill could result in significant costs for low-income Americans, particularly those who rely on safety net programs such as Medicaid and the Supplemental Nutrition Assistance Program. As we wrap up today's show, it's clear that there are many complex issues at play here, with far-reaching implications for investors, consumers, and the broader economy. As always, we urge our listeners to approach these developments with a critical eye and to carefully consider the potential risks and opportunities. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.